All right, let's talk about something huge. We're going to crack open one of the most important documents a country produces, the government budget. You can think of it as the financial blueprint that literally shapes the entire nation for the year ahead. But how does it actually work? Well, let's dive in and find out.
So think about how you manage your own money, right? You've got money coming in, money going out. Pretty straightforward. Now, try to imagine doing that for an entire country. A country with, say, over 1 billion people. That is the monumental task we're talking about with the government budget. So the big question is, how on earth do they even begin to plan for something that massive?
Okay, so at its very core, it's actually surprisingly simple. Just like your wallet, a government budget really just has two sides. You've got the money in part, that's what we call government receipts. And then you've got the money out part, which is known as government expenditure. Seriously, this simple idea, in and out, is the foundation for everything we're going to talk about today.
All right, here's a quick look at what's coming up. First, we'll cover what the budget actually is. Then, we'll break down its key parts, the revenue versus capital stuff. After that, we're going to tackle the big one, the deficit. And finally, we'll zoom out and look at the bigger goals behind all these numbers. Sound good? Let's go.
All right, let's jump right into Section 1, the annual plan. So what exactly is this document that gets so much press every single year?
Now, if there's one word you need to remember here, it's estimated. See, the government budget isn't a history book. It's not a record of what's already happened. No, it's a forward-looking plan. It's basically the government's best guess, a forecast, if you will, of how much money it thinks it will bring in and how much it plans to spend in the next financial year.
And this whole thing runs like clockwork on a really strict schedule. So around February 1st, the big plan is announced. Then come April 1st, the new fiscal year officially kicks off, and that's when the budget is put into action. It runs for a full year, all the way to March 31st of the next year. So, based on all those estimates, a budget can fall into one of three buckets. First, you've got a balanced budget. That's pretty simple. What comes in equals what goes out. Then there's a surplus budget where the government actually plans to earn more than it spends. Honestly, that's pretty rare, especially for a growing country. And that brings us to the most common scenario, a deficit budget. This is where the government plans to spend more than it brings in. And you might ask, why? Well, often is to make big investments, like building new roads and bridges, to really kickstart future growth.
Okay, let's move on to Section 2. This is where we get into the real nuts and bolts of the budget, the difference between what we call revenue and capital items.
So, the whole thing boils down to one simple, crucial rule. Just ask yourself this. Does this transaction change the government's long-term assets, stuff it owns, or its liabilities, stuff it owes? That's it. Revenue items are kind of like your day-to-day finances. Your salary comes in, you pay your monthly bills. They're recurring, and they don't really change your big-picture financial health. But capital items? Those are the big ones. Think buying a house or getting a huge loan. These are one-time events that totally change your financial situation.
Let's apply that rule to the money inside of things. Think about taxes. That's a classic revenue receipt. Why? Because the government is getting money without having to sell off an asset or take on new debt. It's just income. But on the other hand, what if the government borrows a ton of money or sells its share in a public company? Well, that's a capital receipt. In the first case, it creates a new liability. That's the debt. In the second, it reduces an asset. It owns less of that company. See the difference?
And guess what? The exact same logic applies to the money outside. Let's say the government is paying salaries to its employees. That's a revenue expenditure. It's just a regular operational cost. Got to keep the lights on. But what about building a brand new highway? That's a capital expenditure for sure. Why? Because it's creating a massive, valuable, long-term asset for the whole country. And hey, repaying a loan? That also counts as a capital expenditure because it's reducing a liability, getting rid of debt.
Now, since taxes are by far the biggest source of cash for the government, let's just do a quick deep dive here. The real difference between the two main types comes down to one thing: who actually pays the bill. With a direct tax, like your income tax, it's simple. The burden can't be shifted. You earn the money, you pay the tax. But with an indirect tax, like a sales tax or GST, it's a bit sneakier. The tax is officially put on the seller, but what do? They just shift that burden right over to you, the customer, by baking it into the final price you pay at the counter. Okay, let's get into Section 3. So we've already mentioned that deficit budgets are super common. But what exactly is a deficit? And why do we hear people talking about it all the time? Why does it matter so much?
This is the big one, folks, the fiscal deficit. To put it really simply, imagine the government adds up all of its income for the year,
from every single source except for borrowing. The fiscal deficit is the shortfall. It's the gap between what they have and what they need to spend. And that gap, well, it shows you the exact amount of money the government has to go out and borrow to make ends meet for the year. It's probably the most watched number in the entire budget.
Okay, so there are really three main types of deficits you'll hear about, and each one tells a different story. First up is the revenue deficit. This one's important because it shows if the government is borrowing just to pay its day-to-day bills. And yeah, that's not a great sign. Then you have the fiscal deficit, which we just covered. That's the total borrowing needed for the whole year. And finally, there's the primary deficit. This one is super insightful. You take the big fiscal deficit number and you subtract the interest payments on old loans. What's left tells you how much the government is borrowing for this year's spending, separate from the cost of paying off old debt.
And that brings us to our final section. You might be thinking, okay, that's a lot of accounting, so what? Well, the so what is this. A budget is so much more than just numbers on a page. It's not just about balancing the books. It is an incredibly powerful tool for shaping an entire society.
You know, one of the biggest goals of almost any government budget is to try and reduce economic inequality. And this is where all those concepts we just talked about, direct taxes, indirect taxes, revenue, all come together. So how does it work? Well, the government can use progressive taxation, meaning it taxes the wealthy at higher rates. It can slap heavy taxes on luxury goods to make them more expensive. And then, and this is the crucial part, it takes all that collected money and uses it to fund things like subsidies for essential goods or to provide public services and welfare programs for those who are less fortunate. It's a way of redistributing the country's resources to help bridge that gap.
So when you step back and look at it, a government budget is this really fascinating mix of accounting, forecasting, and social policy. It's basically a statement of a nation's deepest priorities, all spelled out in black and white, in numbers. But this leaves us with one final, really big question. We know it's a powerful plan on paper, but in the real world, can a document like this truly bridge the massive gap between the rich and the poor? That's something worth thinking about.